Are you over 50 and still saving for retirement? Beginning in 2026, there's a major change in the tax rules for catch-up contributions that may leave you no choice but to put that money into a Roth account. Congress has decided in its infinite wisdom that higher income savers, currently those who earn $145,000 per year or more, that number will be adjusted for inflation in future years, can't put their catch-up dollars into the pre-tax side of their 401k, 403b, or 457b anymore. Those extra contributions will have to go into the Roth side instead. That change takes away the upfront tax deduction a lot of people have counted on for years, and it changes how your retirement savings will be taxed in the future. In this video, I'll explain what the rule says, who it affects, and 4 often overlooked ways this change can influence your retirement strategy. Let's review a few basics to put this change in perspective. First of all, catch-up contributions are only available to people who are age 50 or older by the end of the calendar year. For 2025, the regular employee contribution limit for a 401k, 403b, or 457b was $23,500. If you're 50 or older, you could add a standard catch-up contribution of $7,500, bringing your total annual limit to $31,000. And if you're between 60 and 63, there's an even bigger window, the so-called enhanced catch-up of $11,250 in 2025, if your plan allows it. This extra allowance is designed to help people in their later working years, often after paying off debts or finishing college costs for their kids, to build up their retirement nest egg faster. Prior to 2026, you had the choice to direct those catch-up dollars to either the traditional pre-tax side or the Roth side of your plan. A lot of higher income earners have chosen the pre-tax or traditional side for the immediate deduction. That's the piece that will change. Here's what will be different. As of January 1st, 2026, if your prior year W-2 wages from that employer are above $145,000 adjusted each year for inflation, you will have to direct your catch-up contributions into the Roth account within your plan. That means you'll no longer get the upfront tax deduction for those extra dollars. You'll pay income tax on them now. The trade-off is that once they're in the Roth account, the money grows tax-free and can come out tax-free later as long as you meet certain rules, which I'll cover in a moment. For a lot of late career savers who've relied on the pre-tax deduction to lower their current taxable income, this will feel like a loss. But, as we'll discuss, it also opens the door to some opportunities. When Congress passed the Secure Act 2.0, it was presented as a way to help Americans save more for retirement. But there was another motive. By moving high-income savers' catch-up dollars into Roth, the government collects the income tax now instead of decades later. That brings in near-term revenue to help cover their budget priorities. In other words, it's as much a fiscal move as it is a retirement savings reform. To understand why this matters, let's revisit the core differences between the pre-tax or traditional and Roth contributions. With pre-tax contributions, you get a deduction now that lowers your taxable income today. Your money grows tax-deferred, but when you retire and start pulling the money out, every dollar is taxed as ordinary income. With Roth contributions, you pay the income tax up front. But as long as you're 59 and a half or older, and it's been at least 5 years since your initial Roth contribution, your withdrawals in retirement are tax-free. For a lot of people at their peak earning years, losing that deduction may feel like a pay cut. But there is a silver lining. Having both pre-tax and Roth buckets in retirement gives you more flexibility. You'll have more control over how you draw income and how much tax you pay later on. We've covered the basics of the new rule. Now let's go a little deeper. There are 4 important considerations that most explanations skip, but each one could make a real difference in how you plan. The first consideration is the long-term impact on your required minimum distributions, or RMDs. Since 2024, Roth 401k dollars that you roll into a Roth IRA are not subject to RMDs. That's a big change, and it's easy to overlook. By being nudged into a Roth for your catch-ups, you could end up with a smaller pre-tax balance in retirement. That means smaller taxable RMDs once you hit your 70s. And that in turn can lower your overall tax bill in retirement and may even reduce the percentage of your Social Security that ends up being taxed. In other words, a rule that feels like a loss today, losing that deduction, may create a long-term tax benefit. The second consideration shows up immediately in your take-home pay. If you've been using pre-tax catch-ups, you've been lowering your taxable income each paycheck. When those contributions shift to Roth, that deduction disappears. You'll owe tax on those dollars up front. For households in the 32 to 35% combined bracket, the difference can be several $100s a month. Because of that, it's important to take another look at your withholdings on your quarterly estimated payments. You don't want an unpleasant surprise at tax time. And you may want to adjust your household budget so you can keep saving what you intend without disrupting other goals. The fourth consideration involves state income taxes, something a lot of savers overlook. If you live in a high-tax state like California or New York, Roth contributions mean you'll pay both federal and state income tax up front. But later, your qualified Roth withdrawals will be free of both federal and state tax. If you're thinking about retiring to a lower or no income tax state, that fact can tilt the analysis. Paying the state tax now, while you're still working in a high-tax state, might or might not be your best move. Thinking about where you plan to live in retirement can make a real difference in how this rule affects you. The fourth consideration is all about timing. There's a special window for people in their early 60s, the enhanced catch-up. It lets you contribute even more during those years, currently $11,250 on top of your regular deferral. Here's why timing matters. If you're 59 today, all the enhanced catch-up dollars you contribute between age 60 and 63 will be forced into Roth once the 2026 rule takes effect. If you're watching this before the end of 2025, you still have a short window, just the remaining weeks of this year, to make any last pre-tax catch-up contributions before the new Roth requirement takes effect. If you're seeing this in 2026 or later, that window is closed. That rule is now fully in effect. Knowing exactly where you stand on this timeline can help you decide how much to save and in which bucket. Now let's review a few technical points so you'll know exactly how the rule is applied. The $145,000 wage threshold is indexed for inflation, so it will gradually rise. Each year, check the updated figure. Don't assume it's fixed. The rule applies to 401ks, 403bs, and 457b plans. It does not apply to simple IRAs or SEP IRAs. Eligibility is based on your prior year W-2 wages from the same employer. That means if you change jobs, your new employer looks at your wages with them in the prior year. If that number is 0, as it would be for a new hire, you can still make pre-tax catch-up contributions in your first year at the new job, even if your current salary is above the threshold. That's one of the few built-in exceptions to the rule. Now let's be really clear about who needs to prepare for this change. It applies only to workers age 50 and older because they're the ones eligible to make catch-up contributions in the first place. It applies only if their prior year wages from their current employer exceed the threshold. If you're under 50, nothing changes for you. You don't make catch-up contributions. If you're 50 or older, but earn less than the threshold, you can still choose whether to make your catch-up contributions pre-tax or Roth. And if you're retired, the new rule doesn't affect the money you've already saved or how you're drawing it out. Planning implications and next steps. This is where a little foresight can make a big difference. Start by estimating your likely tax bracket in retirement. A lot of people think they'll be in a lower tax bracket later, but that isn't always true, especially if large pre-tax balances drive up required minimum distributions. If you expect to face similar or even higher taxes later, shifting more dollars into Roth now may be wise. It could help you lower taxable income in your 70s and beyond. At the same time, think about your current cash flow. Losing the deduction may feel like a pay cut. You may be able to offset part of that by using other deductions that you control, like charitable giving or contributions to a health savings account to balance out your taxable income. Most importantly, remember that tax planning for retirement is a big picture exercise. It's not just about the contributions you make. It's about coordinating all the moving pieces: Social Security, RMDs, state taxes, and more. This is where having an experienced advisor can help you consider all of the variables involved. Before we wrap up, let's consider one common misconception. Many people confuse Roth IRAs with Roth 401ks or Roth 403bs. They're not the same. Roth IRAs have income limits that can keep higher income earners from contributing directly. Roth workplace plans don't have those income limits. The new rule doesn't bar you from contributing. It simply directs higher wage workers' catch-up dollars into the Roth bucket. Understanding that distinction is key so you don't mistakenly think you're shut out of Roth altogether. Now, I know changes like this can feel unsettling. Losing a tax break you've counted on for years can feel like a setback. But this change can also be an opportunity, a chance to rethink your tax picture for retirement. It may help you build a more flexible mix of pre-tax and Roth dollars that gives you more control over your income in later years. If you'd like help developing a strategy for your retirement, reach out to us at Atterbury Investment Management. We help prudent, long-term investors align their strategies with their goals. For more on investing and retirement planning, watch these videos next.